For those of you who don't have enough time to watch the whole video, I'm gonna tell you in about 15 seconds of what this video is about. So first I'm going to talk about, of course, SMCI deadline to Nasdaq on February 25th to kind of comply with all of their rulings. Second of all, I'm going to talk about the convertible notes. These $700 million, which everyone is for some reason very excited about, they have a clause, a very bad one for SMCI. And if you are an investor, you need to know about this. And then we're going to talk about the financial results of the company, their guidance, as if there is no Nasdaq-sized cloud hovering over its head. In the end, I'm going to talk about my take on SMCI and whether I'm investing or not. Hint, I'm not. So let's start. Hello and welcome to the Market Monkeys channel. My name is Vadim, so let me put my "the end is near" sign on and let's start spreading doom and gloom about SMCI stock. So first, let's begin with the Nasdaq ruling and with the deadline on February 25th. So by February 25th, SMCI needs to provide to Nasdaq 3 audited reports. First of all, the 10K reports, the yearly report from 2024, and 2 quarterly reports from Q1 25 and Q2 25. Now, during the latest business update, by the way, right now, this thing SMCI is doing once a quarter. This is called business update and not earnings report because it's not an official audited earnings report. And we will talk about this a bit later. So during their latest business update, their CEO, Charles Liang, was very convinced and told everyone that the company is going to comply and to give Nasdaq everything that is needed by February 25th. But then their CFO, by the name of David Weiberg, came out and he wasn't so sure. So all he said is that the company is pretty sure that they are going to give Nasdaq only the 10K, the yearly report, by February 25th. Now, what about 2 quarterly reports? We don't really know. But what he says is actually much more logical than the message that the CEO of the company delivers. The thing is with these reports is you cannot rush through them. You need to first complete the yearly report, and then quarterly reports are beginning to build on top of the yearly report the year before that. So you cannot just go and work on 3 reports simultaneously. You need to first get the yearly report, get it audited, get it approved by Nasdaq, and then start working on Q1 report, get it audited, approved by Nasdaq, and then Q2 report. Now, will the company make it? I don't think so, because we have, less than a week left before the deadline, and we don't have any news about the company and what they have achieved so far. But I don't think that they're going to make all 3 reports on time. Now, the question is SMCI going to be delisted on February 25th, or they will get another extension from Nasdaq? And if you ask me, I have no idea. I'm not a Nostradamus and I'm not even going to guess, because previously they got extensions from Nasdaq. But based on all of the extensions and based on that this is not the first time SMCI does something like that. And let me remind you, in 2018, SMCI got accused already of, let's call them, accounting irregularities, and they got delisted from Nasdaq then. Will this happen now? I don't know. We will know in about a week. Now, what most people don't talk about, and this is absolutely critical information if you're holding SMCI stock or if you're thinking about, for some reason, buying right now SMCI stock. But anyway, the important thing is these 700 million convertible notes. So SMCI, during their business report, the management said that they have secured additional liquidity for the company by issuing $700 million worth of convertible notes. And they have already done something like that about a year ago, but then they have issued notes for $2.1 billion. So there is a clause in these notes, and the clause said that if something significant happens to the business of the company or to the company itself, the bondholders can get their money back, all the principal plus interest, immediately. So one of these major things which can happen to the company is, of course, their delisting. So potentially on February 25th, if Nasdaq decides to delist the company, and if bondholders decide to get their money back, and they can, I'm pretty sure the company will try to renegotiate with them, but they actually can. The company is about to pay about $2.4 billion back to the bondholders. Now, let's try to do some quick math here. The company right now has about $1.67 billion in cash. In addition, they have these $700 million from the convertible notes, which gives us a bit more money than these 2.1. I'm not really sure about the exact sum, but it's between 2.1 and 2.4 billion dollars what the company is supposed to return to their bondholders. So they do have enough money. The problem is that the company needs cash to operate. They need cash for their manufacturing, and they need cash for their working capital. Currently, their burn rate is about $200 million a month, or about 600 million a quarter. How the company will deal with this situation, I really don't know. I think they will try to renegotiate with the bondholders, but obviously, if they do renegotiate with them, the terms of new loans will be much worse than the convertible notes that they issued right now. If you find this information valuable or interesting, or if I scared you enough, press the like button, subscribe to this channel, and you can become a member of the Market Monkeys channel. Alright, let's try to talk about their business as if all of this stuff I just told you is not happening. So during their latest business update, SMCI reported the revenue between 5.6 and 5.7 billion dollars, which is kind of according to the plan, but it's a slight dip from the quarter before that. The concerning thing is, of course, their gross margin, which keeps on falling, and this quarter it fell by another 100 basis points. We have talked about this in our previous videos about SMCI, that this is actually concerning because the company becomes less and less profitable. It probably has something to do with the pricing. Now, the bad news from this business update is that SMCI has slashed their yearly guidance for 2025 from between 26 to 30 billion dollars in revenue to 23.5 to 25 billion dollars in revenue. Now, instead of kind of owning up to the situation and explaining what's going on, the company has decided to blame everything on Nvidia and to tell that it's all because Nvidia is not supplying their chips fast enough and in enough quantity. Now, these accusations of Nvidia look weird because just last week we got information from both Foxconn and Dell that they are actually growing faster than expected, and these two companies are companies which work with Nvidia, and they are direct competitors of SMCI. So what's going on? It doesn't look like the whole AI sector is shrinking and suddenly hyperscalers do not order anymore. It looks like the problem is with the company itself. And what I think is happening is that suppliers are trying to diversify SMCI away from their supply chain because they're seeing that the company is in trouble. So SMCI has less and less orders coming their way. And about diversification, one thing which is kind of apparent that SMCI is doing none of it. They kind of put all their money, all their eggs in Nvidia basket and putting just everything on these Blackwell chips, despite all the news about the new tariffs, about export controls, and about some issues with Blackwells, about their overheating, for example. We have seen in the past couple of months that the whole trend with hyperscalers, kind of the trend is moving into the direction of custom ASICs. But SMCI is standing on the sidelines and just trying to keep on doing what they were doing for the past 2 years. Now, let me say a couple of things about kind of my investment in SMCI. So I have had position in SMCI before. Once we heard the news about the accounting irregularities again, we sold our position on the same day and just never looked back. Because in my opinion, and this basically is not my opinion, this is kind of the investment theory, but there are two types of risks which you take when you're investing. Systematic risk and unsystematic risk. Systematic is the risk you cannot diversify. It's the market risk, basically. It's the risk for which you are getting paid. That's why, for example, if you're holding shares, you are getting paid more than if you're holding bonds, because you're taking more risk. And the risk you're taking is systematic risk. Unsystematic risk, you're not getting paid for it. Nobody cares that you took this risk. This is a risk of the company which you are taking. For example, what happens right now with the listing of SMCI, it's unsystematic risk. You will not get paid more for taking such a company. What happens with supply of Teslas, for example, it's also unsystematic risk. You will not get paid for taking that. So I have enough risk in my portfolio. I don't want to take any more, and I certainly do not want to deal with legal stuff of the company, who had some weird stuff about like accounting and breaking the tariffs of US government, and some dealing with brothers of CEO, and just investment is hard enough even without this bullshit. Hopefully I told you something new. I told you something to kind of think about. If you found this video interesting or valuable, press the like button, subscribe to our channel, and we will see you in the next video. Take care.